Federal Reserve anticipates further rate hikes at a slower tempo, according to meeting minutes. During their June meeting, the Federal Reserve decided to refrain from raising interest rates and instead opted for a pause to evaluate the impact of the previous 10 rate hikes. The released minutes on Wednesday revealed divergent opinions among committee members, with some advocating for higher rates due to persistent inflation. The minutes disclosed that almost all Federal Reserve officials expressed the likelihood of future tightening, albeit at a more gradual pace compared to the rapid succession of rate increases witnessed since early 2022. Despite expectations of further rate hikes, policymakers chose to maintain the status quo in light of concerns about economic growth. The decision to skip the June meeting came after implementing 10 consecutive rate increases. By leaving the target range unchanged, officials aim to allow more time to assess the economy's progress towards achieving the committee's goals of maximum employment and price stability. Members of the Federal Open Market Committee expressed hesitance based on several factors. They noted that a brief pause would enable them to evaluate the effects of the previous rate hikes, which amounted to a cumulative increase of 5 percentage points, the most aggressive monetary policy action since the early 1980s. The minutes stated, the economy was facing headwinds from tighter credit conditions, including higher interest rates, for households and businesses, which would likely weigh on economic activity, hiring, and inflation, although the extent of these effects remained uncertain. The unanimous decision not to raise rates was reached in consideration of the significant cumulative tightening in the monetary policy stance and the time lag it takes for policy changes to impact economic activity and inflation. Upon the release of the minutes, the market exhibited little reaction. The Dow Jones Industrial Average experienced a modest decline of approximately 120 points in the final trading hour, while Treasury yields saw a noticeable increase. The minutes also revealed disagreements among members. According to the projections presented after the June meeting, all but 2 of the 18 participants anticipated at least one rate hike this year, with 12 expecting 2 or more. The minutes stated, the participants favoring a 25 basis point increase noted that the labor market remained very tight, momentum in economic activity had been stronger than earlier anticipated, and there were few clear signs that inflation was on a path to return to the committee's 2% objective over time. However, even those in favor of tightening agreed that the pace of rate hikes, including 4 consecutive 0.75 percentage point increases at consecutive meetings, would slow down. Many officials also noted that, after rapidly tightening the monetary policy last year, the committee had reduced the pace of tightening, and that a further moderation in the pace of policy firming was appropriate to provide additional time to observe the effects of cumulative tightening and assess their implications for policy, the minutes explained. Since the meeting, policymakers have mostly maintained their stance on the inflation fight, emphasizing the need for caution. Fed Chairman Jerome Powell, in his remarks to Congress a week after the June meeting, reiterated that the central bank has a long way to go to bring inflation back to the 2% target. Despite some reservations, there has been a broad consensus among the 18 Federal Open Market Committee members that rates will remain unchanged for the rest of the year, with all but 2 participants predicting an increase in rates. This sentiment has remained largely unchanged, as officials wait for the lagged effects of the 10 previous rate hikes to manifest in the economy. While inflation remains elevated, data has generally supported the Fed's position. In May, the Fed's preferred inflation gauge showed only a 0.3% increase, although the annual rate remained at 4.6%. The labor market has also exhibited signs of loosening, although job openings still outnumber